Hello everyone, I hope you guys are doing great and studies going in full swing. In today's video, we would be discussing the CA Final Financial Reporting November 23 paper, especially the tricky and important questions in complete detail and discussing the other questions which are kind of repetitive. So, especially for questions like consolidation, question number 1, where it is slightly difficult to kind of interpret from the institute's solutions because different students have different ways of solving. We have solved this completely separately, so I've kind of solved this and I will share this entire solution notes on the Telegram channel as well. Over here, we have discussed at length about the dividend adjustment, the bonus adjustments, etc. and the various alternative possibilities which are possible. So, let's get started. I would expect that you will probably have a brief understanding of the questions and we will tackle and discuss all the adjustments that the institute has done. So let us get started. The first question over here is the consolidation question. I would say one of the most important and the tricky questions and one of the most talked about questions over here. It is a fairly interesting question, I would say. There is a company Hammer who has acquired a company Sleek. Now, a standard balance sheet is given and then you have been told that various adjustments are there. So in the first adjustment, you have been told that Hammer acquires 20,000 equity shares of Sleek on 1st April 2022 at a cost of 2,40,000 and then further acquires 17,500 on 1st October 22 on 1,92,500. So there are multiple steps over which this acquisition happens. If you go to the Sleek balance sheet, Sleek has 5 lakh rupees and hence that is equal to 50,000 equity shares. Now that means that on 1st April, 20,000 out of 50,000 and hence they have acquired 40% stake. Now this does not give them control and then another 17,500 shares out of 50,000 that gives around 35% stake and hence 1st October 2022 is a relevant date when the control is acquired. Now at this point you should remember Ind AS 103 which mentions that you should apply the business combination standard once control is acquired, that is 1st October 22. If there was an existing investment prior to that date, that investment has to be remeasured, it has to be taken at fair value and the difference, if any, if nothing is given, is to be adjusted against the profit and loss. So that one adjustment is there which you should be careful about. Second, there is intercompany debentures as well. So the 8% debentures of Sleek include debentures held by Hammer of a nominal value of 35,000. These were acquired by Hammer on 1st January 22 at a cost of 84,000. Now, if you go to see in this particular case, this is an intercompany debenture investment. Debentures, remember, do not give you control and hence will not go into the goodwill working. However, intercompany debentures will have to be eliminated and hence this has to be considered separately. Third, you have been given the retained earnings of Sleek on 1st April 22 and the general reserve balance also being given. So these are the opening reserve balances which are available. Then at the fourth point, this is the slightly tricky point. We will discuss what is to be done over here. Sleek has paid a dividend at the rate of 10% of its equity share capital out of the balance of retained earnings as on 1st April 2022. Remember the acquisition date is 1st October 22 and as a result this is dividend paid out of the retained earnings on 1st April 22 and hence this is paid out of the pre-acquisition profits. For the financial year 21-22, the entire dividend received by Hammer was credited in the statement of P&L. Now, the challenge in this particular case is we have not been given that on which date the dividend is paid. Is it paid between 1st April 22 to 30th September 22, that is before control was acquired, or is it paid after 1st October 22 up to 31st March 23 after control was acquired? So, what we have done is in our solution, we have given you both the possible alternatives. Institute in its main suggested answers and even in the certified copies when we have seen has considered implicitly that the dividend is paid out of the profits from 1st April 22 up to 30th September. That is, this is paid out of the profits on 1st April 22 but it is paid before the date of acquisition. So this will have a material impact on your solution. So we will discuss that. So the ICI assumption over here is the dividend is paid out of the profits on 1st April 22 that is given and this is paid before 1st October 22, that is before the acquisition date. Okay. Now as per the resolution dated 20th February 23, Sleek had allotted bonus shares, that is 1 share for every 10 shares out of its general reserve. Question very clearly tells you it is out of the general reserve and accounting effects has not been given. So in case of bonus, there are two ways in which you can solve. One of the ways is you can kind of reverse the effect of bonus. If the effect of bonus was earlier given, you can reverse it because bonus at the end of the day is a book entry and hence ultimately you can reverse it, or you can give the effect of bonus and then show the workings. Again, in our solution we have done the effect considering both, just to showcase that the effect in both of them will be the same. Okay, so we're just kind of going through the question and then we will jump on to the method and the solutions. Sixth, the trade receivables of Hammer include bills receivable of 2 lakhs drawn upon Sleek. Out of this, 50,000 bills have been discounted with the bank. Remember, if the bills have been discounted, that means that in the books, let us say of in the books of the person who is discounting, we will kind of receive the money. However, in the books of Sleek, where let us say the bills are payable, earlier we thought that Sleek has to pay to Hammer and hence it is intercompany and to be eliminated. But if Hammer discounts the bill, then it kind of showcases that Sleek has to pay the money, let us say, to the bank, and hence it is a liability which will continue to appear and it will not be eliminated. So over here, your intercompany elimination for the bills receivable payables will happen only to the extent of 1,50,000. The bills which have been discounted will not be eliminated because Sleek has a liability to pay to the bank. Okay. Point 7. During the financial year 22-23, Hammer purchased goods from Sleek. Hammer is purchasing from Sleek. Hammer is a parent, Sleek is a subsidiary, and hence this appears to be an upstream transaction of 25,000. Sales price is 30,000 and hence there is a 5,000 profit. 40% of these goods remain unsold on 31st March and hence you will eliminate the unrealized profit, that is 5,000 into 40%, that is equal to 2,000 worth of profit will be eliminated. 8th, on 1st October 2022, a machinery of Sleek was overvalued. 1st October is the date of acquisition. So on this date, the machinery of Sleek was overvalued by 20,000, for which necessary adjustments are to be made. Remember, when you acquire control, then you will take over assets and liabilities at fair value. Over here, it seems that for the machinery of Sleek, the value is 20,000 higher, and hence for the purpose of taking over, you will reduce the value by 20,000. That is an initial fair value adjustment at the time of acquisition, and depreciation is to be charged at 10%. So there would be a corresponding effect on depreciation after the acquisition date as well. So this is the fair value adjustment. And then point 9. The parent company of that is Hammer has adopted accounting policy to measure the NCI at fair value, which is a quoted market price, by applying Ind AS 103. Assume the fair value of the equity share of Sleek is rupees 11 as on the date when control is acquired, that is 1st October 22 is a date when control is acquired. You are required to prepare a consolidated balance sheet as per Ind AS of Hammer and its subsidiary Sleek as on 31st March 23. This is a 20-mark question. Going forward, you will not have 20-mark questions, so probably a few adjustments kind of may be removed, but nevertheless, for a overall understanding, it is important that we kind of do the entire problem in its entirety. So what are the steps that we usually do? Step number 1, we prepare the schedule 3 balance sheet. So over here, it is actually a blank balance sheet. I've solved it entirely in the interest of time, so we don't invest a lot of time in writing stuff during the video. So over here, you will prepare the entire schedule 3 balance sheet based on the data given in the question. That is your step 1. Step number 2, you will note down all the assets and liabilities as given in the question. So over here, you will note down your PPE, which is 6 lakhs and 3 lakh 25, comprising of plant and machinery, furniture and fittings. Then you will look at your intangibles, which by the way includes goodwill, which is a little strange, but nevertheless keeping it as it is, which is goodwill. Then you have inventories, investments. You will note down all the assets and all the liabilities except for the share capital of each of these companies and reserves of each of these companies and investment in equity shares. So except for that, as you see over here in the second step, we will note down all the assets, all the liabilities as they appear. Okay, all the assets, all the liabilities as they appear. Now this is a very standard step where you note down assets and liabilities. Institute over here has also done this in a tabular form. Sometimes they show it separately for parent and subsidiary, or we prefer doing it in a tabular form. Here they've also done it in the tabular form, as if you see the suggested answer. So this is standard. Then you show the equity share capital. Equity share capital, remember, represents the share capital of the parent. So you would have taken all the assets. Investments, we'll see what is to be done. Just a minute. You will have taken all of these assets, not share capital and reserves. Then you will have, let us say, borrowings, overdraft, everything would be taken. So this will take care of all of these assets and all of these liabilities. Now when we look at investments, now investments in the books of Hammer would include investment in equity shares of Sleek. Now these investment in equity shares is like purchase consideration that you must have paid, which will go into the goodwill workings, and hence you will not consolidate them, rather you will eliminate it. And hence when you find the investment, your total investment, if you go to see over here, comes to be, let us say, 6 lakh 25. Now out of this 6 lakh 25, we can say that probably 2,40,000 and 1,92,500. So this is 240 and 192,500. That is around 4,32,500 is your investment at cost. Remember, at cost in Sleek. And as a result, we will remove them and find the other investments. By the way, these other investments may also include investment in debentures of Sleek. But investment in debentures will not go into the goodwill working. Investment in equity shares will go into the goodwill working. So over here, if you go to see, we'll have 1,92,500. This is after deducting the investment in equity shares, which are there in Sleek, which you will show separately in the goodwill workings, and 1,25,000, which is appearing over here. So that is taken care of. Then you have equity share capital of Sleek, which you will show as equity share capital. And then you go to the crucial items, the crucial 3 working notes that you prepare. Working note number 1, consolidate other equity, where you will take the reserves of the parent. So this is 2 lakh and 3,50,000, 2 reserves, general reserve and retained earnings. So you prepare a working note 1, which is standalone hammer. So the reserves are taken. Then you will take the goodwill workings, working note 2. Now there are a couple of things that are important over here. In this case, goodwill is to be calculated on the acquisition date, and the acquisition date over here is 1st October 2022. Now on this date, the way you calculate goodwill typically is PC plus NCI minus net assets. In a typical consolidation question, you might not necessarily have the net assets as on the date of acquisition. However, you can back calculate the net worth as on the date of acquisition, and this net worth will kind of give you an understanding of what the possible net assets would have been. Okay, so in this particular case, one needs to remember that NCI is to be calculated using the fair value method, and if NCI is calculated using fair value method, you will have to take the PC. To that, you will have to add the NCI at fair value, and from that subtract 100% of the net assets or net worth, because NCI is calculated using the fair value method, and hence the workings would be slightly different. Okay, so how will you do these calculations? First of all, you will try to find the investment in your ledger. Your investment appears at 2,40,000. This is the investment at cost on 1st April 2022. However, Ind AS 103 says that as on the acquisition date, this investment has to be remeasured at the fair value. How will you find the fair value? Well, the last adjustment tells you that the fair value of the shares of Sleek as on the date when control is acquired is 11 rupees. And as a result, we will say that these 20,000 shares that you are holding into rupees 11 will give you 2,20,000. However, you have paid how much? 2,40,000, and hence you will have to bring down the value of the investment by 20,000, and hence an adjusting entry can be passed. That is profit and loss account debit. Profit and loss, let us say of hammer account debit, 20,000 fair value loss or loss on remeasurement, to let us say investment in Sleek. So over here, if you go to see, you will have a slightly new adjustment where you will take the 2,40,000 of investment, that is a 40% stake. From that, subtract the fair value loss, and hence you will get 2,20,000. This is the fair value on 1st October for the 40% stake. The second effect for this would go against the profit and loss. So this is fair value loss of 20,000 to be reduced from the profit and loss. Now this is to the extent of 40% stake. However, there is also 1,92,500 that you have paid for the 35% stake, which is on 1st October 22, which will be a part of your investment. So this is 35% stake, 1,92,500, and hence for a total 75%, that is 40 plus 35, your total value for goodwill calculation on 1st October 22 would be 4,12,500. So no problems over here. This is how it should have been done. Institute also in a way has done this working. Now you have eliminated the investments, you have taken the reserves. So what next? Well, you have to calculate the NCI. What is the NCI? Well, out of the 50,000 shares, 37,500 is held by Hammer, and hence the remaining 12,500 representing your 25% stake is held by the NCI. Now 12,500 into rupees 11, that comes to around 1,37,500 will be the fair value of the non-controlling interest as on the acquisition date. So you will start on 1st October 22 with the fair value, that is 1,37,500. Remember, you want to calculate the full goodwill in this case, and or the full its NCI at fair value, and hence to the PC, in order to calculate goodwill, you will add the NCI. So over here the NCI gets added on 1st October 22, which is 1,37,500. This is the slightly different method that you do in case NCI is measured using the fair value, which is different from NCI measured using proportionate net assets. So at this stage, you are done with that. So we have taken care of even the share capital of the parent. We have shown that. We have taken the reserves of the parent. We are yet left with the share capital of the subsidiary and reserves of the subsidiary. So when you look at the share capital of the subsidiary, we will say 100% of the share capital. 100% of the share capital is attributable, let us say, to the goodwill workings, because 75% of that is attributable to the parent, which has gone in the working note 2 for goodwill, and another 25% is also attributable to the NCI, which has also gone over here, and hence 100% of the share capital is attributable, let us say, to in the goodwill working. No part of it is separately taken to NCI because NCI is already recorded at fair value as on the acquisition date. So this 5 lakhs is also considered. So now what is remaining? At the end of the day, we are just left with one thing, which is 3,75,000, which represents the reserves of Sleek. So you will have to do analysis of the reserves. So till this point, you have considered all of these balances and you do the analysis of reserves. So when you try to do the analysis of reserves, we prepare this working where you have the particulars, then you have general reserve, then you have retained earnings, total pre and post, total pre and post. So how will you do the workings? Well, to start with, we will take the balances which are there as on 1st April 22. Remember, that is not the date of acquisition. Date of acquisition is 1st October 22. So you will take the balances, let us say on 1st April 22 to start with, that is 75,000 and 50,000 for the general reserve. So you will take 50,000 for the general reserve, 75,000 for the retained earnings, and then from the balance sheet, you will take 125 and 2,50,000 in the closing. So 125 for the general reserve, 2,50,000 for the retained earnings. You will post that. Now during the year, why would these balances change? Well, they will change due to profits earned during the year, that is 22-23, and also appropriations. Now appropriations over here are of two types. One is dividend, one is bonus. So there will be an increase due to profits, and then there would be a reduction due to, let us say, dividend or bonus as a case maybe. So we will do these workings. Now, are we given the data regarding the dividend? Okay, so let us look at this adjustment. So let us say we have considered the effect of adjustment 1. We have even taken the reserves were required. Now the problem is dividend. Now the question says that Sleek paid a dividend of 10% on its paid up share capital. Now Sleek's share capital is, let us say, 5 lakhs into 10%, and as a result this comes to, let us say, 50,000. Sleek paid a dividend at the rate 10% on the paid up share capital out of the balance in retained earnings on 1st April 22. Now this balances, remember, is pre-profit. So this is dividend clearly paid out of pre-profits for the financial year 21-22, and the entire dividend received by Hammer was credited to its profit and loss. Now the problem is the question does not tell you when the dividend is received. So if it was received during 1st April 22 up to 30th of September 22, at this point we were showing investment in Sleek, and if you are receiving any investment dividend on this investment, this dividend has to go to the P&L account, and if it has already gone into the P&L account, it will require no further adjustment. However, if the dividend was received from 1st October 22 up to 31st March 23, now at this point you are no longer showing the investment, however you are showing the net assets of Sleek. You have consolidated the assets and liabilities of Sleek, and by that date on 1st October 22 you must have also calculated the goodwill, post which, remember, post which in the second assumption dividend is paid, and as a result you will have to make certain adjustments in case the dividend is paid after 1st October 22. Now the question remains silent, and hence in such a case the easy way out would always be that you consider the dividend is paid prior to the acquisition date. If it is paid prior to the acquisition date, your net worth as on the acquisition date is already lower, and hence there is no further adjustment needed, and dividend should have gone to the profit and loss, has gone to the profit and loss, and hence no further adjustment is needed. Now that is what the institute has assumed. So if you go to see, we have subtracted the dividend of 50,000 over here and reduced it from the pre-acquisition profits. We have mentioned a working note 5A where we have mentioned over here that assuming dividend is paid before 1st October, this is the ICAI assumption. Since it is dividend for the year 21-22, it is reasonable to assume that it must be paid before 1st October. Hence no adjustments are needed to adjust net worth as on 1st October. 1st October is the date of acquisition. As on that date, the dividend is already paid. Usually the sums that you do in the books that are there are usually dividend that is paid after the acquisition date. If the dividend is paid after acquisition date, you will need to do certain adjustments as I've seen and given to you in the box below so that you get a holistic understanding. Prior to 1st October 22, the shares were held in the nature of investment and dividend should go to the profit and loss, and hence no adjustment is needed, and hence if you open the ICAI suggested answers, there is no adjustment. That is the institute solution. However, let us say you were specifically told that the dividend was paid on, let us say, 1st November 2022. Then there would be certain adjustments, because then this dividend would be paid on 1st November, and hence your net worth or net assets as on 1st October when you're acquiring control would have been slightly different. And as a result, we need to back calculate the net worth or net assets as on the acquisition date, and hence we need to pass that adjusting entry. Typically, you pass the adjusting entry where you reverse your share in the dividend receipt from the profit and loss and credit the net worth or goodwill workings. However, because this is using fair value method, your initial NCI appears at fair value, and hence extra possibility. This is not what is there in the question, but assuming dividend is paid after 1st October 2022, then your adjusting entry will be consolidated retained earnings account debit 37,500. That is your share of the dividend, which you must have credited to the profit and loss account and to the pre-acquisition net worth, because the net worth as on the acquisition date would have been higher to that extent. Achha, but you are taking 50,000. Why? Because we are taking 100% of the net assets, and as a result 37,500 is merely your share. However, because you are doing NCI at fair value and doing full measurement, 25% of this would be adjusted against the NCI, and hence you will, if this extra case was there, you would have also reduced your share in the pre-acquisition dividend, which I have taken as 0 over here. Here you would have reduced 37,500. In the goodwill workings, you would have a pre-acquisition dividend where you would have taken 50,000, and in the NCI you would have taken 12,500 reduction, and that would have given you the answers, which would be slightly different, but that alternative answers should have been accepted if the dates were given to be after 1st October. So this is the extra possibility on an adjustment if dividend is paid out of pre-acquisition profits after the date of acquisition. This is dividends paid out of pre-acquisition profits but before the date of acquisition, and hence it does not have any effect. So this is the first complicated or tricky adjustment that you need to be aware of. You can just refer the notes. Here I am discussing the entire question to the extent possible, but you should refer the notes for getting a better hang or a better understanding. Okay, so that is taking care of dividend, where there are two possibilities. Institute has solved using the possibility of dividends paid before the date of acquisition. Then comes bonus. Achha, we'll keep aside bonus for some time. We'll do bonus as the last adjustment, because bonus, there are two ways in which you can solve, and both of them will give you the same ultimate answer. So there is no need to get confused because of bonus. So let us keep aside bonus for the time being. Next you have trade receivables. Well, this is an intercompany adjustment, and hence this will not really impact profits. It will just be a working against your bills. So you will have trade payables account debit to trade receivables by 1,50,000, and when we show the assets and liabilities, within the assets, within the trade receivables reduce 1,50,000, within trade payables also reduce 1,50,000. Achha, before you forget, there was also an adjustment too, where you were told that there are certain investments that Hammer is made in Sleek's debentures. Now these debentures have a face value or nominal value of around 35,000 if I am not wrong, and you have invested around 84,000. So for something, a liability of the subsidiary which was merely 35, we ended up spending 84. In my consolidated balance sheet, this needs to be eliminated, and hence 8% debentures in the books of Sleek will be eliminated up to 85,000. 2 investment in debentures will be eliminated in the books of Hammer for 84,000, and there is a 49,000 loss. Now that is not for acquiring control, and hence this will be adjusted against the profit and loss. This is excess payment made by Hammer appearing in the books of Hammer, and hence NCI will not have any share in this, and hence if you see the adjusting entry, remember entries need not be passed in the main exams. I've just given you these entries for a much more clearer understanding and explanation. You should, if you don't have time, skip these entries as long as you can give the adjustment effects clearly. This is just for your understanding. So this is 8% debentures account debit 35, to investment in debentures 84, and hence consolidated earnings affected by 49. So this effect will go into loss of elimination of debentures, working note 4B. This is 49,000 adjusted. No effect for this will go in the goodwill. Now after this, we have to say that, well, at the end of the day, let us say we ignore the bonus issue for the time being, then we would say that your opening was 50, closing is 125, and hence during the year 75 is earned. Similarly, in retained earnings, if 50,000 dividend is paid, the balance figure is 2,25,000. Well, the date of acquisition is 1st October, and hence half would be attributable between pre and post. So 37,500 pre, 37,500 post, 1,12,500 pre, 1,12,500 post, and hence you will find the balances, after which if required you will make certain adjustments. So for this you have done the adjustment for debentures as well. Bonus is remaining, which we will do at the end. Then you have this upstream upstream profit of 2000 is included in the profits of the subsidiary, that is Sleek, and hence if you have to eliminate it, a simple adjustment would have been profit and loss of Sleek account debit to, let us say, inventory. But the question is, this must be out of which profit? Well, if nothing is given, usually this is always assumed out of the post acquisition profit, assuming these transactions must have happened in the post acquisition period. And hence, in line with the institute's solutions as well, we have adjusted this from the post acquisition profits of the subsidiary. The second effect for this will go against the inventories. 2000 is to be reduced. So this is also taken care of. Achha, next you have this adjustment for machinery. Remember, machinery is overvalued, and hence you will have to reduce the value of the machinery. So you will have to credit the machinery, reduce the machinery as on the acquisition date, which means this losses has already arisen up to the acquisition date, and hence we adjusted against the pre-acquisition profit. So over here the effective entry would be profit and loss, the pre-profit and loss or retained earnings account debit to, let us say, machinery. And as a result, over here, when you look at your notes, your machinery will reduce by 20,000, and so will your pre-acquisition profit and loss. There is an initial fair value change of 20,000. All the entries I have given at the end. You can refer that. Now, if your machinery is lower by 20,000 and the depreciation rate is 10%, that is 2,000 will be the savings in depreciation. But for the entire year, after acquisition 6 months have gone by, so 2000 into 6 by 12, and hence there will be 1000 savings of depreciation as compared to what was recorded in the books of Sleek, and hence savings in depreciation. So machinery will be debited by 1000 and your post acquisition profit and loss will be created, because this pertains to the depreciation from 1st October to, let us say, 31st March. And as a result, over here, when we do these workings, this would be 1000 added for the machinery and 1000 added in the post acquisition section. So this takes care of all of these adjustments except for the bonus adjustment. Now bonus adjustment, if you go to see, so we have given working notes for each of them, and we have tried to in blue give the explanation wherever required for your better understanding. So all of these unrealized profit, fair value adjustments are done, and then comes bonus. Now remember, bonus at the end of the day is a book entry, and if it is a book entry, usually you pass the entry reserves account debit to share capital. Reserves belong to whom? The owners. Share capital belongs to whom? The owners. And hence, even if you ignore the bonus, it will not matter, because it does not entail any outflow of resources to anyone. And as a result, ideally, even if a bonus entry is passed, you could have reversed it and done the working. Or in this case, since the bonus entry is not passed at all, you may just skip giving the effect of bonus. Sir, but bonus is actually given by the subsidiary. How does it matter? Subsidiary share capital does not get consolidated at all. For subsidiary share capital, it gets eliminated, and hence bonus, even if you ignore, works. So what I have done is, so that you are clear, I have done this entire working ignoring the effect of bonus. We said that okay, bonus is not passed, let it be, let us keep the bonus as 0. No sir, but bonus is given, but it is given in the subsidiaries books. In any case, it is a book entry, and hence we can ignore. No sir, but institute, what has institute done? Institute has considered the effect of bonus. Then how will you solve? So below this, in working note F, I have given an extra working entirely. If you go to see in a box, that what will happen if you were to pass an entry for bonus and record the bonus and then give the effect, you will see that the ultimate solution remains the same up to the last decimal, and hence I'm pretty sure that any of the methods will work. But if you want to stick to the institute's method only, then in the box I've shown the extra working. If you're running out of time, which you will, if you sit and solve such a huge question, you will be really out of time, then having such tricks in place really helps you. So over here, usually in bonus alternative 1, we reverse the bonus effect since it is a book entry. So ignore the bonus adjustments in this case, since entry for bonus is not passed. So there's no question of reversing anything. The entry for bonus itself is not passed. So over here, as you can see from the general reserve, I have not adjusted any bonus. Sir, but bonus, if bonus would have passed, then we would have seen what is to be done. We will do that in an extra part. But here I have not done anything. Ideally, my share capital after bonus will not be the same. My share capital would ideally be different. So as per the resolution on 20th February, bonus shares for 1 for every 10 shares. So if there are 50,000 shares, then 50,000 into 1 by 10. And hence that is going to be around 5,000 bonus shares are going to be issued of the value rupees 10. Hence 50,000 will be the quantum of bonus. So I can either ignore the bonus while doing the reserves, and then even while I look at the share capital, I just take 5 lakhs. I ignore the effect of bonus. That is my main solution. Alternative solution, what the ICAI has done is they have considered the bonus, in which case what would happen over here is you will pass the entry for bonus and then adjust, like bonus is coming out of general reserve, so your entry will be general reserve account debit, let us say 50,000, to share capital, let us say 50,000, in which case your adjusted equity share capital will become 5,50,000. So what will go in the goodwill working is 5 lakhs along with 50,000, which is the adjustment for bonus, because that is a share capital that you will need to eliminate. Similarly, the general reserve that you will take, which currently appears in the end of the year as 1,25,000, will be 1,25,000 minus 50,000, and hence it will be 1,25,000 minus 50, that is equal to 75,000. So if you were to record the bonus, which the institute has done, then your adjusted general reserves would have been 75, your adjusted share capital would have been 5,50,000. If you were to take that into your calculations, there will be no effect on any other thing except for working note 2 and 4. But to be clear, we are also showing you the working note 3, but there will be no other effects at any other place. Your consolidated balance sheet, notes on assets and liabilities, consolidated reserves, everything will remain the same. So when you do the goodwill working, all of this will continue to remain the same. There will be no difference. However, when you look at the share capital, your share capital now will be a 5,50,000 share capital, that is equity share capital, and bonus of 50, which you can show separately. So this will be the slight difference. Further, when you do the analysis of reserves, your closing reserve, general reserve, will be 75,000 and not 1,25,000, because there is a bonus. And since you have considered 75,000, then we will also deduct the bonus, and unless given otherwise, we can assume that the bonus is out of the pre-acquisition reserves, and institute has also allowed that. So this 50,000 can be taken out of the pre-acquisition reserves. So this would be the difference. You can sit at peace and understand these treatments through the board note that I will be sharing. I'm just kind of running you through. So this would be the treatment for bonus if you want to separately give the effect for bonus. Okay. So after all of that is done, you will find the adjusted reserves and then split it between hammer and the NCI. Now remember, the pre-acquisition reserves you can split between parent and NCI. However, NCI is already shown at fair value, and hence there will be no further allocation of the pre-acquisition profits to the NCI. However, profits after the acquisition date will be attributable to NCI, and hence I have split the post-acquisition profits between parent and NCI. The pre-acquisition profits, 100% of them will entirely go into the goodwill working. So I say working note number 2, and hence this entirely goes into the goodwill working. 87,500 and 1,17,500 entirely goes into the goodwill working. From the post-acquisition section, when I look at 28,125 and 83,625, this is your share in the post-acquisition profits, and hence you will take 28,000 and 83,000 over here, and the NCI 9375 and 2785, this will go in the NCI workings. And with that, you have, it's a wrap, and you have taken all the workings. Once you have taken all the workings, you will start totaling. So you will first total up the reserves, 2,28,000 and 3,64,000. This will go into your consolidated reserves, 2,28,000 and 3,64,000. Then you will try to find your pre-acquisition net worth, which would have been 7,05,000, and hence a 1,55,000 gain on bargain purchase or capital reserve, as the case may be. So this is shown as a capital reserve over here as 1,55,000. In my opinion, it could have been very much possible to offset it and net it off from goodwill, because I'm acquiring a subsidiary. First of all, there is some goodwill appearing in the subsidiaries books. If there's also a capital reserve, you should net them off, but institute has shown it separately, so we show it separately over here, 1,55,000 within the capital reserve. Okay, and 1,74,750 will be your non-controlling interest, which will appear in your balance sheet. Ajay sir, what would have happened if I would have taken bonus, in which case my general reserve pre-acquisition would have been 37,500. Currently, if I go to see, my general reserve pre-acquisition is actually 87,500, and hence this general reserve is higher by 50,000. But at the same time, my share capital I have taken is 5 lakhs. So what happens actually over here is, even if you consider the bonus in my goodwill workings, I will take the equity share capital at 5,50,000, that is 50,000 higher, but then my general reserve would be 37,500, that is 50,000 lower, and hence that 50,000 internally compensates each other. Your goodwill or capital reserve continues to remain at 1,55,000. Your NCI continues to be at 174,450, and everything else, if you go to see, remains the same. So as we have concluded, as can be seen, the answers remain the same. But if you want to follow the institute solution, like even if we have discussed in class for bonus, you can give the effect for bonus and solve, or you can reverse, ignore the bonus altogether and solve. Your ultimate answers would remain the same, as we can see over here. So in my opinion, if you are short of time, which you would be if you were to solve such a large question, you can safely go with alternative 1 assumption, where you ignore, ideally the bonus effect should have been reversed because it is a book entry. Here they have not given the effect of bonus, so there's no question of reversing it. You will ignore it altogether. But if you still want to give the effect, you do it the way we have done in this extra working, and that should absolutely be fine. You will get exactly the same answers to the last decimal. After that, you will total up all the assets and all the liabilities. Over here, you will total up all the assets and all the liabilities. Take that into the consolidated balance sheet. Pray to God, and hopefully your balance sheet should tally. If it does, at 25,87,500. So this is regarding a brief discussion of the consolidation question. Obviously, it's a much more deeper and interesting question. Please do ensure that you revise this, and that is probably one of the best questions that is there in this November 2023 paper. Okay, so next we go to the next important questions. Okay, rather important or not, when you look at question number 2, subpoint A has been deleted. This was pertaining to CSR, and that subpoint CSR is no longer applicable, and as a result we need not refer this. Subpoint B is a question which is very similar to Ind AS 115 question, which is there in your books as well, where there is an airline ticketing company who is responsible for tickets, and you are required to determine whether it is a principal or an agent. If I just quickly glance through it, not too much into detailing. XYZ is a sales and marketing commission company in the entertainment domain, negotiates and agrees in advance with 4 famous amusement parks to purchase their tickets for online sale through its payment gateway to the public. The negotiated rates are at a discount when compared to the price of the tickets sold directly by the amusement parks to the general public, and XYZ is free to determine its sale price on the ticket. So XYZ has pricing discretion. So this is the first important part. As a part of the agreement, XYZ will also assist amusement park with respect to services provided by the parks to the public, or each amusement park will continue to be responsible for fulfilling its obligations with the ticket, including solutions to dissatisfied customers. It is so giving the rides etc. is the responsibility of the amusement park, but the entity is purchasing the tickets and then selling it. XYZ, there is no credit risk as payment is collected from the customers beforehand. However, it carries an inventory risk as tickets have to be purchased in advance and unsold tickets are lost to XYZ. So there is an inventory risk. And as a result, whether XYZ is a principal or an agent, we have discussed is exactly this is a principal because the responsibility for the tickets lies with the entity. It does have the inventory risk. It also has the pricing discretion, and hence it meets the responsibility of a principal. And it is not an agent. It is similar to the airline example that is there in the study material as well as in our books. So that is a brief reference you should refer. Next is subpoint C, which is slightly different. This is on cost incurred to obtain a contract acquisition cost. When you look at contract acquisition cost, these are costs that the entity will have to incur if it obtains the contract, and it will save if it does not get the contract. So these are costs which are incremental in nature, and the standard mentions that hypothetically you should ask yourself that if the parties to the agreement were to walk away just before signing the deal, would these costs still be incurred? If your answer is yes, then they are treated as contract acquisition. Sorry, if the parties to the agreement were to walk away, and the cost, would the cost still be incurred? If the cost will still be incurred, we are saying that these are not incremental to acquisition, because even if the contract is not entered, you are still incurring it, and hence they are not treated as contract acquisition cost. However, if these costs will be saved, if the contract is entered, if the contract is kind of not entered, and it will be incurred. If the contract is, then they are contract acquisition cost. To put it simply, let us say there is a brokerage or a sales commission. You will have to pay for it if the contract goes through. You will not have to pay for it if the contract is not. But something like traveling expenses for your salesmen will have to be paid irrespective of whether you get the contract or not. And as a result, the traveling expenses are not treated as contract acquisition cost, whereas the sales commission is. Keeping that brief background into mind, you have 6 specific points which are asked, 1 mark each. Commission paid only upon successful signing of the contract. Is that cost incurred to acquisition? Yes, and hence this would be capitalized. Legal fees for drafting the terms of the arrangement or agreement. Well, this kind of depends. In general, if these legal fees are only to be incurred if the contract goes through, then the answer is yes, to be capitalized. But if they are legal fees in general of executing the contract, you will have to pay the lawyer whether the contract is actually signed or not, and hence ideally this should be expensed. This will not be contract acquisition cost, though an alternative solution is possible. Institute has also given an alternative solution depending on the facts. So over here, no, this would be expensed. Next, travel expenses of a salesperson pitching for a new client contract. So if I don't get the client contract, do I not have to pay the traveling expenses? No, I still have to pay the traveling expenses, and hence this would be expensed. It is not an acquisition cost. It is not incremental in nature. Salaries of salespeople working exclusively on obtaining new clients. This is salaries, which means even if they don't obtain any new clients, you still have to pay them salaries, and hence they are not incremental in nature, and hence expenses over here would not be contract acquisition cost. You will expense them. Bonus payable on quarterly sales. Remember, sales would usually happen only if you get the contract, will not happen if you don't get the contract, and hence this can be, yes, contract acquisition cost, which will be capitalized. And commission paid to the sales manager, which is based on contracts obtained. Very clearly given that this is based on contracts obtained, and hence yes, this will be capitalized. Okay, so this is point C. Then you go to question number 3. I would treat this question part A as also important. This is a question pertaining to leases, where you have to test for various things: separation of lease and non-lease component. Then you have to see for the lease liability, etc. Again, a couple of assumptions that you might need to do over here. So let us review this. A consumer products entity, that is entity A, who is a lessee, enters into a lease agreement with entity B, who is a lessor, for a dedicated production line. So this is a dedicated production line, which means there is an identified asset to manufacture one of its store branded household products for a period of 3 years. Entity A has agreed to order a minimum of 1 lakh units per month and to make a payment to entity B as per the following agreed rate. So there is a minimum payment of 1 lakh units per month, and hence this will result in what we call as an in substance fixed lease payment. There will be a fixed lease payment in substance that you have to pay. That is 1 lakh per month. So the rates are 240 per unit if the ordered quantity is between 1 lakh to 1 lakh 20, and 246 per unit if the ordered quantity is between 1 lakh 20 to 1 lakh 50. Which means your in substance minimum lease payment is 1 lakh if I take this in lakhs into 240, and hence this comes to around 240 lakhs. Okay, this is the in substance fixed payment that has to be made. But is it the payment only for the lease, only for goods? Well, it appears to be for the goods only. There does not seem to be anything for the lease. Is there a hidden lease? Well, for there to be a hidden lease, there has to be a dedicated asset, which is the production line, whose right to control usage should be with the customer, that is the lessee. Like, substantially all benefits from the production line will flow to the lessee, and the usage has to be controlled. If that is the case, then well, there is a hidden lease. But apart from that, there is also some job work element, which may be a non-lease component. So over here, you might get access to use that production line. However, the other entities manufacturing the goods and giving to you, that is, they are doing job work for you, and hence when you are paying 240 lakhs, you are not just paying for the production line, you are paying for the production line along with the services that the other party is giving you, that is job work services. So there is both a lease and a non-lease component over here. Now, as per the terms of the agreement, entity has the exclusive right to use the production line. So that gives you substantially all the benefits coming from the line. Entity B cannot use the production line for any other customer. The type of household product is specified in the contract, and entity A issues instructions to B about the quantity and timing of products to be delivered. If the production line is not producing the household products for entity A, it remains idle. So substantially all benefits clearly are flowing to A, that is a customer only. Entity B operates and maintains a production line on a daily basis. A has estimated that for manufacturing each unit, B incurs an average cost of 195. Now this is a slightly controversial case where they have mentioned that B incurs a cost of 195. Okay, fair enough. Further, the observable standalone price for the rent of the production line is 60 lakhs per month. Entity A's incremental borrowing rate at commencement is 10%. Now ideally you will have to allocate the payment, that is 240 lakhs, between the lease, that is a production line, and the non-lease, that is job work, in the ratio of the standalone prices. Now the standalone prices for just renting the production line, if no one was manufacturing any units for you, if you just wanted the line, maybe you will have to employ people and do the manufacturing, then probably they would have charged you 60 lakhs. But you are not paying 60 lakhs, you are paying 240 lakhs. Why? Because you are in a way getting a right to use the line. At the same time, you are also getting the products manufactured by them. So that is for job work. So that is a composite payment for both. Okay. Entity A concludes that the arrangement contains a lease as per Ind AS 116. It also, so over here the question tells you that. Had the question not told you, you would have looked at the first paragraph, said there is a dedicated production line, so there's an identified asset which we assume that the supplier, that is B, cannot substitute. The third paragraph over here mentions that this is for the exclusive use for A, and considering A gets the right to direct use, control use, we will say that this contains a lease. But is it only lease? No, along with lease there is also non-lease component. There are certain job work services whose benefits are coming to you. So over here the question says that it concludes that the arrangement contains a lease. Okay, the arrangement has two components. One is the lease component, that is a right to use an identified asset, that is a production line, and a non-lease component, that is job work. It also elects to apply, it also elects not to apply the practical expedient in para 15 of 116 of not separating the non-lease components, which means you will separate the lease and the non-lease components. Accordingly, it separates the non-lease components from the lease components. Perfect. Analyze the above and identify the lease components and the non-lease components. So basically the lease component over here is the right to use the production line, that will be the lease component, whereas the non-lease component, so if I go to see the lease component, this is the production line for which you will pay the rent, and the non-lease component is, let us say, something like the job work. Now if you go to see, it seems that as per the agreement, you are going to pay 240 lakhs. 240 lakhs is 1 lakh minimum units into 240 rupees, so that is 240 lakhs. It does not appear that you are paying anything for the lease. It appears as per the agreement the entire 240 is for the products only. However, Ind AS 116 says that the allocation over here has to be the ratio of standalone price. So if I look at the standalone price over here is 60 lakhs if I show everything in lakhs for the lease, and it should be ideally 195 into 1 lakh, that is 195 lakhs. Now in my opinion 195 is not entirely correct, because 195 is the cost. Your allocation has to be based on the standalone prices. So ideally there would be some markup. If the job worker is incurring 195 of cost, he is not going to expect to recover only 195 from you. He will probably expect to recover around 200, 205, etc. So ideally that should have been the base, but if that is not available, you will have to take 195. Had they told you that on a regular job work, a 10% profit margin is expected, then you would have taken 195 plus 10%, and that would have been taken for the base of standalone prices. And as a result, this is what, if I total this comes to 255. But am I paying 255? No, I'm paying 240. Maybe I'm getting a combo discount. And as a result, if I were to do the allocation over here would be 240 into 60 divided by 255 towards the lease component, and 240 into 195 by 255 towards the non-lease component. So this is what 240 into 60 divided by 255 comes to, let us say, 56.47. Obviously you will have to take the full numbers if you are taking like the way it is done in the solution. I'm just kind of explaining it principally and hence doing it in lakhs. And this is 240 into 195 upon 255 comes to around 183.53 approximately. Now this is not a variable lease payment. A variable payment will be the payment beyond 1 lakh units, and that will not go into the lease liability calculation because it is variable, not linked to rate or index. The 240 payment is a in substance fixed lease payment, and hence for calculating your lease liability we will take 56.47 approximately. So over here you are required to analyze between the lease and the non-lease component. Point 1, and at the commencement date. Point 2, compute and allocate the consideration into lease and non-lease component. So probably 56.47 and 183.53 is the allocation. Compute the lease liability. Achha, this is where the problem arises. The present value factor at the rate of 10% per annum at 2.49 for 3 years may be adopted. Now the question tells you that. Now in my opinion, if that was not given, ideally your payment of 56 towards the lease component is a per month payment, and hence your ideal lease liability will be 56.47 into the present value annuity of the monthly factors. of the monthly factors at 10% divided by 12, that is 0.83% monthly rate for 36 months. Ideally, that should be the case. However, because they have taken the annual, they have told you that you use the annual factors. ICAI also over here, what it has done is 56.47 into 12. So it has found approximately 56.47 into 12, that is 677.64 lakhs. 677.64 lakhs. This is the payment per annum, and your lease liability is the present value of the future lease payments, that is 677.64 into 2.49 PVAF, 2.49, and hence this is around 1687.3236 approximately lakhs, or if I take this in crores, this is around 16.87 crores. So you will take around 16.87 crores as a part of your lease liability. Okay, if I just were to verify this, if we were to verify this, you can see over here 56.47, 183.53, and lease liability per annum payment is 677 and 16.87 crores. As you can see, 16.87 crores is your lease liability. This is point 3. Point 4, determine the recognition and treatment of the lease components and the non-lease components. Well, you are not asked to pass journal entries or do any working, so we will explain. For the lease component 1687.32, you will apply the amortization method. Your effective rate would be 10% per annum. Had you done monthly, that would have been 0.8333% per month, and in each month you would have shown a 56.47 payment. In this case, for each year you will show a 677.64 payment, and ultimately this will become 0. At the non-lease component in each year, approximately 183.53 will be shown as job work expenses. No specific standard applies. It is not a lease component, it is a non-lease component, and hence 183.53 will be taken to the profit and loss as job work charges. Now the institute solution, as you see, ends over here. However, one can always mention that what will happen if there was an excess. If there was excess products manufactured, fundamentally that is variable payment, not linked to rate or index, and hence if you were to again allocate in the ratio of standalone prices, there can be variable lease payment which will also go to the PNL, and the other part linked to job work will also go to the PNL if that case arises, though the institute has not commented any of that, and hence we can stop based on this over here. So that takes care of question number 3. Ideally, that per month and per annum working over here is something which is a little kind of confusing. You could have taken the monthly factors, though if you have specifically been given to use the annual factors, you should use the annual factors. So this is question 3, sub point A. Now sub point B is 105. Over here there is a particular way in which you can solve, though there is an alternative solution in my opinion which is possible. Though the institute's solution does not cover that, we will just discuss this once. The following details are available for Hydra as on 31st March 23. So you have carrying value before classification is held for sale, and carrying value is remeasured before classification is held for sale. Okay, so over here this is on 31st March 23. You have been told this is data immediately before classification is held for sale. Hydra estimates that the fair value less cost to sell for the disposal group is 65 lakhs. Now if I were to take the value as remeasured, this should be 6750, 20 lakhs, 2850, 11 lakhs and 7 lakh 50. So total is around 74 lakh 50,000. So if I take the difference of 74 lakh 50,000 and 65 lakhs, this difference comes to around 9 lakh 50,000, which is a write-off which is to be required under Ind AS 105. Now this write-off under 105 will first be adjusted against goodwill. So out of this 9 lakh 50, 7 lakh 50 will be adjusted against goodwill, and hence the remaining, after this there is a remaining 2 lakh rupees. This 2 lakh rupees will be allocated among the eligible assets. Now what are the eligible assets? Is PP eligible? Technically yes. Is building eligible? Technically yes. But investment in equity instruments and inventory would be measured as per the respective standards, and hence no loss would be attributable to them. So if I actually go to calculate to PP as well as to building, I will allocate in the ratio of their carrying values. So this is what, 20 is to 28.5. So this is, let us say, 2 lakhs into 20 upon 48.5, 2 lakhs into 28.5 upon 48.5. So if you do this working, 2 lakhs into 20 upon 48.5 comes to around 82,000 474 attributable to PP, and 2 lakhs into 28.5 upon 48.5 comes to 1,17,526, and this would be reduced. Now this is what the institute solution has done. If you go to see, institute has actually done that. In my opinion, that is not entirely correct, because if the question specifically tells you over here that PP is carried at revalued amounts, and it comes out loudly and says that carrying value as remeasured immediately before, so this 20 lakhs would already be the fair value, and hence you should not ideally take the value of a PP below its individual fair value, and hence ideally the entire 2 lakhs should have been absorbed by building. In my limited understanding, that solution should have been possible. Now institute over here has allocated 82,474 as well as 1,17,526 respectively to the PP as well as to building, considering probably revaluation must have done in the past, and as a result currently I cannot prove that they will not bear this loss. In my opinion, since they have been told that they are carried at revalued amounts, there should have been an alternative treatment for sure possible, but now considering the way institute has solved, we can see that we will have to follow the treatment unfortunately. So that is 20 minus 82 allocated even for the PP, and for the building also around 1,17,000 is allocated. Ideally an alternative solution should have been that nothing goes to the PP because it is already at the revalued amounts, in which case if building cannot prove, then the entire 2 lakhs could have been attributed to the building, though we will now refrain from doing this because, well, as per past trends, preferably do what the institute does. Okay, so this is your sub point B. Now sub point C is similar to a question which is there in Ind AS 21, though in that question you are also asked to show the effect in the CFS. In this particular question they've just directly asked what is to be done in the SFS. So this is more of an Ind AS 21 question. I would not really put a lot of weight behind this. This is something that you have done. In fact, the question that is asked over here is a much more simplified version than what is there in the study material. So N is engaged in the manufacturing of bottles for pharma companies and non-pharma. It has a wholly owned subsidiary H, which is engaged in the business of pharma. H, which is a subsidiary, purchases the pharma bottles from its parent. The demand is very high, and to cater to the shortfall, it also purchases from other companies. Purchases are at competitive prices. General paragraph. N sold pharma bottles to H for euro 24 lakhs. Who is N? The parent. The parent sold the bottles for euro 24 lakhs. And hence, parent, if parent is an Indian company, well, they have not yet mentioned. So let us see. So parent has sold on 1st February 23. The cost of these bottles was 1660 in the books of N at the time of sale. So N seems to be showing everything in rupees. However, these bottles are sold in euros, and hence Ind AS 21 will apply. You will record them at the exchange rate prevailing as on the date of the transaction. As at 31st March, all these bottles were lying as closing stock in the books of H. H has not yet sold it. As on 31st March, the entire amount against the supply of these bottles was also payable, which means this is not settled in cash. The functional currency of H is the euro. H is a subsidiary who is the buyer, and N is INR. N is the parent who is the seller. The additional information is available on 1st February, the rate is 83, and on 31st March, the rate is 85. Provide journal entries in the books of N and H on the transaction date as well as on 31st March. If any, assume the NRV of the stock was always equal to the cost. Are you asked to show anything in the CFS? No. In the study material question that we have done in class, the CFS adjustment is also done, where you eliminate unrealized profit on inventory and you also eliminate the intercompany receivable and payable. In this case, that is not asked, and hence we can just restrict our understanding to H and to N. So N over here is the parent which is having INR currency. It is selling goods, and hence entry will be H account debit to sales. Now when it passes this entry, this will be at euro 24 into rupees 83, that is exchange rate prevailing as on the date of transaction. 24 into 83 comes to around 1992. And at 31st March, at the year end, you will remeasure the receivables, that is at 85. So basically this will be H account debit to forex gain, and this will go to the profit and loss. This is basically 24 into 85 minus 83, and hence this is going to be 48 rupees. Remember, in the books of H, which is a subsidiary, the transaction is happening in euro only, and since it is in euro, it will pass the entry purchases account debit, let us say to N, that is at 24 euros. Now I don't have to remeasure anything because the transaction is happening in my currency. As on the balance sheet date, my inventory will be shown at 24 euros, which is the same as the NRV, and hence there will be no further write-off for me. Yes, at the stage of consolidation, this payable to N will be translated to the closing rate and it will be eliminated against the receivable. Further unrealized profit, that is 1992 minus 1660, I think 332, will also be separately eliminated. That is if CFS was separately asked, which is not the case over here. So that is taking care of this third part. Next part is your favorite financial instruments question. This is similar to a multiple time exam question and your study material question, where there's a compulsorily convertible preference share and this comes with the transaction cost. A very standard question. I'll just quickly discuss this rather than going into the entire solving. So you are engaged in drilling and mining over 25 years. General management is planning to expand on 1st April 19 to meet the finance requirement. You issued 50,000 compulsorily convertible preference shares of 100 rupees each. That is, issue price will be 50 lakhs. The preference shares carry a coupon of 12% per annum. 50 lakhs into 12% comes to 6 lakhs per annum. Payable every year. The company has substantial profits for payment of dividend. Under terms, every 2 preference shares are converted to 1 equity share. So this is a fixed number. So 50,000 preference shares will convert into 25,000 equity shares of rupees 100 each at the end of the 4th year. So there is an obligation to pay 6 lakhs per annum for 4 years. Prevailing annual market rate for similar debt without the conversion option is 15%, and the transaction cost for this instrument is 3%. So in line with the institute solution. Okay, there are faster ways to do it as well. If I want to find the liability component, I'll say that there is a contractual obligation to deliver cash at the rate of 6. Remember, my issue price without considering the transaction cost is going to be 50 lakhs. 6 into the PVAF, 1 divided by 1.15, 1, 2, 3, 4, and hence this is what, 2.8550, and hence 6 lakhs into 2.8550 comes to around 17 lakh 13,000 approximately, and hence your equity component should come to around 32 lakh 87,000. Okay, now there is transaction cost. Transaction cost is 3% of 50 lakhs. So 50 lakhs into 3% comes to around 1 lakh 50, and this 1 lakh 50 of transaction cost will be attributed in the ratio of the liability is to equity component, and this will be deducted. So this is 1713. From this, let us say you deduct, you will get approximately 16 lakh 61,610. Equity component also you will approximately deduct. So this is around 31 lakh 88,390. So this is 48 lakh 50 of your net proceeds, which will be attributed between liability and equity component, and further the liability component will be adjusted at the EIR given to you at 16.6%. You will prepare the amortization table and solve. Compute the liability and equity component. If you go to see, around 3287 and 1713 will be your liability component. Institute, as you can see, has taken 4 decimals. So this is always a question that should I take 3 here. As you can see, they have taken 4 decimals. Over here, your liability component, equity component, you reduce the transaction cost and you get the answer. Going forward, you will provide the liability ledger. So instead of preparing a table, you will prepare the ledger where your opening balance will be 17 lakh 13 into 16.6% will be your interest, and 6 lakhs in each year will be the payment, and you will find the closing. So that ways you can prepare this ledger. So this is for the liabilities. Each year you will make a payment, and accordingly this will keep on going down and down. The journal entries are asked in each year after the initial entry is passed. In each year it will be interest account debit to liability, that is preference shares, and then preference shares, that is liability account debit to bank for 6 lakhs. So this is the payment entry and this is the interest entry, and in the last year you will have equity component account debit to equity share capital to securities premium, and accordingly. So just your starting will not be around 17 lakh 13. Obviously your starting will be your 16 lakh 61,000, which is kind of the number over here, which is after the transaction cost. I think you should be broadly comfortable with this. If not, go back and buckle up on your financial instruments working. We have done this multiple times. Even the rates have been given over here. You will take those rates. Okay. So discuss the cost constraint for usefulness of financial information or discuss the characteristics of good financial information. See, these are general theory questions on conceptual framework. When you look at the good characteristics of financial information, not statements, as they have rectified, it is reliability and relevance. So when you look at relevance and timeliness over here, these are two. So is the data relevant? Is it available in a timely manner? Is it relevant for making economic decisions? Is what you will see. And is this faithfully representing the substance? You are not just accounting as per legal form. Is it representing the substance as well? And the cost constraints, well, you have to look at whether the cost of preparing the data justifies the benefit that a reader perceives to get from the data, and accordingly you can just self read the theory for this, and if this comes up again, score those easy marks. Okay, so that is regarding the theory. Now question 5a is also an interesting question. This is regarding share based payment, a slightly different type of a question which was asked. So let us review this. Now A announced a stock appreciation right, SAR. So this is a cash settled plan on 1st April 2020 for each of its employees. The scheme gives the right to claim cash payment equivalent to an excess over the market price of shares on the exercise date over the exercise price of 250 per share in respect of 100 shares. So the appreciation over 250 per share will be paid in cash in respect of 100 shares, subject to a condition of continuous employment for 3 years. So the vesting period seems to be 3 years. The SAR is exercisable after 31st March 23, as you could have inferred from 1st April 2020 to 31st March 23, but before 30th June 2023. The fair value of the SAR was, so you have been given the fair value on 2021, 21-22 and 22-23. If it is a SAR question, you have to look at the fair value at each balance sheet date. ESOP question, yes, you look at the fair value on the grant date. In 2021, the company estimates that 2% of its employees shall leave the company annually. So this is an estimate. Estimate, remember, always applies to future employees leaving. Actual employees who have actually left will be clearly seen in front of you. So your estimate will be for the remaining years. This was revised to 3% for 21-22. Okay, actually 15 employees left the company in 2021, 10 in the next year and 8 in the next year. Therefore, the SAR actually vested in 492 employees on 30th June. They've just mentioned later that this is 31st March, but nevertheless, let us say we take it as whatever was given. When the SAR was exercised, the intrinsic value was rupees 50 per share. Remember, your intrinsic value is the actual appreciation on a particular date. As per Ind AS 102, your expenses, your SBP liability will all be recorded based on the fair value. But the moment an employee retires, then you have to actually make the payment that will be based on the intrinsic value, because the employee does not understand Black and Scholes binomial model. They will demand payment based on, let us say, the intrinsic value. Compute by the fair value method. Even if it was not given, we would have done the fair value method. The SAR expense for the financial years. Each of the years. Also provide the SAR ledger from inception till closure. Discuss whether this account is in the nature of liability or equity. Well, this is in the nature of liability because there is a contractual obligation to deliver cash. Now, one very important ingredient which was missing over here is the number of employees. We don't know how many employees are there on the grant date, but if you can back calculate, you know that the options vested with 492 employees at the end. However, this 492 is after all employees who are leaving. So in the past, actually, I see 8 employees have left, then 10 employees have left, and then 15 employees have left. So if I total up, this is what? 525 employees must be there as on the grant date. Out of which at the end, I know 492 are employees who have exercised and options have vested. But I don't know that on 31st March 2021, on 22. Probably I know that in 23, but not earlier. So if I had to find the number of employees estimated to remain, let's say if I'm doing the working for the year 2021, my number of employees estimated to remain would be 525 minus, I can actually see 15 employees have left, and hence I have 510 employees, and out of that I'm expecting 2% of them to leave. Estimated 2% to leave in the coming year, so that is 0.98 will continue, and another 2% to leave, so that is minus again 2%, that is 0.98 to continue. So this is 510 into 0.98 into 0.98, this comes to 489.8, can be taken as 490, can be taken as 489, or even in decimals it can be taken. We know that the employees cannot be in decimals, but institute has given you credit even if you take this in decimals. I will round it off to the nearest number, so let us say I take it as 490 into, so that is 490 employees expected to continue, and every employee getting 100, and the fair value at the end of the first year is 42. So this is your total expense, but this has to be prorated. 1/3 of this will be recorded in the first year minus earlier recorded 0, and hence this is 490, for example, into 100 into 42 divided by 3 comes to around 6,86,000 to be recorded in the first year. When you go to the second year, 21, 22, again I need to find the number of employees. So this is 525 minus 15 and minus another 10 who have left. So which means I'm left with 500 employees, out of which 3% are expected to leave, and hence 500 into 0.97. I expect 485 employees to continue till the end of vesting, each employee having 100 shares, and the fair value now is 46. So this is what, 48,500 into, let us say 46 into 2 by 3. So this is into 2 by 3 less earlier recorded. This is 6,86,000. So from this, if I subtract 686, I do get 8,01,333. And now for the year 22-23, I actually can see 492 employees are there, into 100 into the fair value is 48. Intrinsic value may be something else, but the fair value, let us say, is 48. So this is 49,200, 492 into 100 into, let us say, 48 into, let us say, 3 by 3. So this is into 3 by 3 less earlier recorded is 14 lakh, I think 87,333 minus 1487,333, and hence it is around 8,74,246. At this point your liability appears at this number. However, later, maybe by 30th June or maybe by 31st March, whenever the exercise happens, and when the exercise happens, the payment actually is at 50 rupees. So your actual payment would be 492 into 100 into 50, the intrinsic value, and hence this is 49,200 into 50 minus, let us say, in your ledger you have recorded 49,200 into 48, you have recorded 23,61,600, and hence the difference of 98,400 is also additionally paid to the employees, which will be taken as EB. So if you go to see your total cost, you will prepare the ledger, etc., will be 686. It will be 8,01,000, it will be 8,74,000, and again 98,100, 98,400 of cost, and this will be, all of these are EB items, will be prepared as a part of your ledger. Ultimately the payment will be released to bank. So this is on 30th June. So this is your working for question number 5A on ESOP. 5B is actually a segment question. It appears to be tricky, but it is actually like a CA inter type of a question if you read it properly. So let us review this. Heyman Limited has 3 segments, H, M and D. The following information is provided for the year ended 31st March 2023. So over here you have, let us say, amount in lakhs, sales to M, sales to D. So these are inter-department sales. Then other sales which are domestic, and export sales. So basically when I prepare the segment report, I will show segment sales. When I show segment sales, there would be, let us say, domestic, export and inter segment. For example, so if I do as H, M and D, over here there would be domestic sales which is done by H at 10 rupees, export sales are 680, 170 and 40. Apart from that, there is nothing else over here. If you look at inter-segment sales, there is 500 inter-segment sales over here and another 5 over here. So this will be shown. So basically you have your total segment sales. Segment sales include inter-segment sales. So this can be shown as segment sales, and then from that you'll have to reduce the inter-segment sales to find the enterprise sales. So if you go to see over here the presentation sales, as you can see, this is the external sales, to which you add the inter-segment sales to find the total segment sales, and then from that you subtract the inter-segment sales. So this is your presentation. You can even mold this around. So this is just presenting the way it is there. Operating profit or loss before tax. Now this is like segment result. So you'll prepare a separate section on result. You'll have 35 and -8. Even if it is negative, so be it. Relocated cost from head office. At the end of the day, it is a cost, and this is a cost allocated from the head office. So it would be adjusted separately, and hence 4, 2 and 2 would be subtracted from the segment result. Interest cost is financing in nature. Segment result is only operating. So you will separately subtract 2, 3 and 1 as well. And hence that will give you your segment result. So if you go to see your segment result minus relocated cost, reallocated cost, from this minus the finance cost, and hence this will give you the profit. If there was tax, you would have even shown a separate adjustment for tax. Then you have fixed assets. Well, again, other than fixed assets, you can show PP or even non-current assets in a separate 0.3, 24 and 2. Net current assets again you separately show, and long-term liabilities also again you separately show. Along with that, you will also show these 5, 3 and 2. So if you go to see over here, you will have reportable and then 5, 3 and 2 to be shown as a part of your head office or unallocated items. You can show that separately as a separate column, or even you can put a separate row showing unallocated as well. That's fine. So this is just a presentation. This is the primary segment. Again, secondary segment, you have to show if there is any data regarding sales, which is there for export and domestic. So probably 10 and the remaining, I think 600 and or 890, you will show 10 external and 890, and that is total sales, and that is just about it. So if you go to see, it appears to be fairly scary, but for 8 marks, it is just a presentation. Yes, share capital and reserves, you can even show in the total unallocated items as well if you want to show. Institute has not shown this in suggested, though in the study material questions you have total assets, then you have total liabilities on which share capital and reserves have been separately added. So even if you add that, that is not a problem. So that gives you the segment report as per Ind AS 108. Very easy question, but it is slightly different as compared to the study material questions, so might be a little challenging that way. Now point C, beauty purchased. Again, this is similar to question Ind AS 38 question. We have done this in the study material and in our books as well. So beauty limited purchased a patent right on 1st April 2020 for 4,20,000, which has a legal life of 10 years. Due to highly competitive nature, the management estimates a life of only 6 years. So which means 4,20,000 divided by 6, that is 70,000 will be the amortization. So 4,20,000 each year, 70,000 will be the amortization. Okay. So this will come down to 3,50,000 at the end of the first year. Straight line amortization is the best method. As at 1st April 21, that is 1 year later, management is uncertain that the process can actually be made economically feasible and decides to write down the patent to an estimated value of 2 lakhs. And then there's a 1,50,000 downward revaluation. A doubt always arises that, sir, is this treated as a impairment under Ind AS 36 or a downward revaluation? Institute in the study material as well as in the exam question has taken it as downward revaluation, probably because they have given estimated market value and not recoverable value. Had they given recoverable value, we could have treated this as impairment as well. Though an alternative solution treating this as impairment is also possible, though Institute does not do that. So this is coming down to 2 lakhs, and also decides to amortize it over 2 years, and hence the further amortization will be 1 lakh rupees. Okay. As at 1st April 2022, having perfected the related process, the asset is now appraised at a value of 3,50,000. So this is again assuming you are following a revaluation, you will take it up to 3,50,000. That is an upward revaluation of 2,50,000. This is not treated as reversal of impairment under 36 because that 1,50,000 reduction was not treated as impairment under Ind AS 36. So an alternative solution could have been possible. Institute has not done that. So this is 1 lakh to which you will add, let us say, the 1,50,000 which was earlier adjusted through the PNL, and the excess, let us say I have to take it up to 3,50,000. So that is, I think, another 1 lakh will be added, and that 1 lakh will be added against the revaluation reserve. So this is 2,50,000 to be added, and hence this is 3,50,000 in total. Furthermore, the estimated useful life is now believed to be 3 more years, and hence 3,50,000 divided by 3, which comes to around 1,16,667, will be the future amortization. Value of intangibles at the end of 2021, which probably comes down to 3,50,000, then 21-22, then it comes down, I think, to so we have done this working, and you can see these numbers. Discuss the treatment of revaluation gain in the year 22-23. 1,50,000 will go to the PNL, and the remaining 1 lakh will be adjusted through the revaluation. So as you can see, 3,50,000 in the first case, 1 lakh in the second case, and going forward we can see that 1 lakh will be adjusted against revaluation, 1,50,000 will be charged to the profit and loss account, and amortization will be 1,16,667. Okay, so moving on finally to the last question. The last question over here is on Ind AS 101. This is on first time adoption, more of a theory based question, similar to the one which is there in the study material. Over here, if you have first time adoption and you have a subsidiary which was earlier not considered to be subsidiary because control was not defined accordingly, then you have the option to restate past business combinations as per Ind AS 103. Or if you can take the previous gap carrying value. So both choices are available. In this case, they decide to take the previous gap carrying value, and if they take the previous gap carrying value, then I will not restate the past combination. But does not mean I will ignore everything. Why? Because you will have to take over the assets and liabilities at least from the transition date. At what value will you take it over? At the values in the subsidiaries individual financial statements restated on the transition date as per Ind AS, and your investment which was appearing in your books till then would be taken as a deemed consideration and goodwill will be calculated. So this is similar to a question which we have done, but nevertheless let's discuss. Diamond is transitioning to Ind AS. It has certain investments in rubies, convertible debt instruments which are currently on the date of transition exercisable and would provide Diamond with a controlling stake. So that gives us control, and hence Ruby seems to be a subsidiary. Ruby on exercise of the conversion rights, Diamond evaluated that Ruby should be treated as a subsidiary under Ind AS. Is that fundamentally right? Yes. Hence it would require consolidation in its Ind AS financial statements. Okay, but I'm transitioning to Ind AS. Ruby was not considered as a subsidiary, associate or joint venture under previous gap, and hence I must have just shown investment in Ruby as a separate line item. How should Ruby be consolidated on transition to Ind AS? Assume that Diamond has opted to avail the exemption from retrospective restatement of past business combination as per Ind AS. So I will not go back and retrospectively restate the past business combination, but on the transition date, whatever is the Ind AS values of Ruby will be taken over, and the investment will be deemed to be the purchase consideration, and accordingly goodwill will be calculated as on the transition date. So this is the theory solution if you go to see. Okay, point B appears to be a little complicated, but it is fairly manageable, I would say. Poor borrowed 120 lakhs from a scheduled bank. So poor ke liye this is a financial liability. The terms of a loan are as under: rate of interest at the rate of 10% per annum payable annually, and tenure of the loan is 12 years. So 120 ke upar 10%, that comes to 12 lakhs each year, unless given otherwise. We'll assume that the 12 lakhs is paid in each year. Principal to be repaid at the end of the tenure, that is 12th year. Okay, perfect. So it's a bullet payment. Poor Limited defaulted in the payment of interest in years 5, 6, 7 and 8. So it paid interest till 4 years. So if I were to prepare the amortization table, it will be 120 to start with your opening balance. This is assumed that the loan is at market terms. 12 will be the coupon, 12 is paid, your closing will be 100, and so on and so forth. This will continue till 4 years. Now at the start of the 5th year, your opening balance will be 100, your effective interest accrued will be 12, but nothing will be paid, and hence your closing will be 112, and so on and so forth. You will continue to prepare the amortization table. A loan rescheduling took place at the end of the 9th year. So 5, 6, 7, 8 so you did not pay. Even in 9th probably you did not pay, and in the end of the 9th year there is a rescheduling that happened. As per the agreement, poor is required to pay 220 lakhs at the end of the 10th year. The default continued till the 10th year. So even in the 10th year, whatever was the interest was not paid. So you can prepare the amortization table, or you can say that, well, at the start of the 5th year, 120 was there in the ledger, on which 1.1 will be the interest for the 5th year, 1.1 for the 6th year, 1.1 for the 7th year, 1.1 for the 8th year, 1.1 for the 9th year, and even 1.1 for the 10th year. This is how the institute has done. I would prefer if you prepare the amortization table, if you have time, it is a little more easier, and hence you can even take 1.1 raised to 6. So this is 1.1, 2, 3, 4, 5, 6, and just a second, 1.1 raised to 2, 3, 4, 5, 6 into, let us say, 120, and this comes to around 212.59 in your ledger. Book value of the loan at the end of the 10th year should be 212.59. Additional amount to be paid to the bank on account of rescheduling. So you have to pay 220 minus 212.59, and hence simplistically you just have to take the difference of 7.41. You don't necessarily have to apply the substantial modification or extinguishment accounting, because the question does not ask you any of that. It just says calculate the book value of the loan at the end of the 10th year, and it just says what is the additional amount to be paid. It does not say that calculate the gain or loss on extinguishment, modification, etc., and hence none of that should be done. But if it was asked, you could have done this at the end of the 9th year and figured out whether this was a substantial modification or not by comparing the present value of the modified cash flows at the end of the 9th year with the carrying value, deciding whether it is greater than or equal to 10%, and you could have done that, but that is not specifically asked, and hence we have not done this. The institute has also not done this. Okay, then you have point C, which is on component method of amortization or depreciation for PP, similar to an example which is there in the study material as well. A shipping company is required by law to bring all of its ships to dry dock every 5 years, okay, for a major inspection and overhaul. Overall expenditure at first might seem to be a repair of the ships, but there is actually a cost incurred in getting the ship back to a seaworthy condition. As such costs must be capitalized. The question very clearly tells you that those costs have to be capitalized. A ship costed 40 crores with a 20-year life will have a major overhaul every 5 years. So will you capitalize the overall expenditure which are expected to be incurred after 5 years today? The answer is no. That expenditure will be recorded or capitalized when it is actually incurred. However, when I amortize 40, should I amortize 40 over the entire 20 years? Again, the answer is no, because a part of this will require what you say as replacement or so after 5 years. But what part of it? Well, 5 lakhs out of it, which the estimated cost of the first overall is 10 crores, not 5 lakhs, 10 crores out of which will require probably what you call as a so-called replacement after 5 years, and hence don't do 40 plus 10 is equal to 50. You have spent 40 today. Ideally, if nothing was going, that 40 would have been depreciated over 20 years. However, out of this 40, there would be 10 rupees over for which you will have to incur certain expenditure which you know after 5 years, and hence out of that 40, 10 is componentized and will be amortized over a 5-year period, and the remaining 30 over the 20-year period. You are required to calculate the depreciation for the first 5 years. We would say that okay, the 10 divided by 5 plus 30 divided by 20, and hence this is what? 2 plus 1.5, and hence this would be 3.5 per annum, and hence if I take 5 years, 3.5 into 5, that is around 17.5. The carrying value at the end of the 5th year, that is 40 minus 17.5, that will come to around 22.5 will be the carrying value. This is your answer to point C. Again, the last question, that is point D. HD Incredibles had in the recent past made a rights issue. In the offer document to its members, it had projected a surplus of 50 crores during the year ended 31st March 2023. That is fine. The draft result for the year 31st March 2023 prepared on the Haitartho, that is earlier followed accounting policies, and presented for the perusal of the board showed a surplus of 5 crores. Fair enough, this is as per the prevailing policies. The board in consultation with the MD decided on the following. Acha, what do I have to do at the end? If you see, discuss the above situation as per the applicable Ind AS, particularly Ind AS 8, that is policies, estimates, errors, etc. Whether the above changes are changes in policies or changes in estimates is what is asked. Sub point 1, value year end inventory at works cost. Works cost is like factory cost, for example, including even the overheads, instead of the earlier method of valuing inventory at prime cost, which only includes material and labor. Is that a change in accounting policy? Well, institute has said that this is a change in accounting policy. So this is accounting policy change as per ICAI. Now ideally one can also show that this is an error, because Ind AS 2, if you see, Ind AS 2 never allows you to record anything at works cost. If Ind AS 2 were to be followed, then the true recognition should be based on, let us say, including the overheads only, and hence if you have not done that, that is an error which requires a retrospective restatement. Institute over here has treated this to be an accounting policy change, which is also a retrospective restatement. But in my opinion, we can also show this as an error, though ICAI has shown this as an accounting policy change. Not to provide for after sales expenses during the warranty period. Till the last year, provision of 1.1% of sales was made under the concept of matching cost against the revenue. So we were taking 1% as a policy, and actual expenses were to be charged against the provision. So as and when they actually happened, you charge against the provision. The board now decided to account for the expenses as and when they actually incur. So as per accrual, Sales during the year was 80 crores. Now, we have recorded to account for the expenses as and when they are incurred. Now, is that a change in policy? Well, yes, if that is permitted by the standards, you can change it. So, this is also treated as an accounting policy change, where your policy earlier was to record expenses based on 1% of the sales, and now you are recording it as on an actual basis, if permissible, under the respective standard like Ind AS 37 or Ind AS 115, if permissible, then you will treat it as accounting policy change. Provide depreciation for straight line method on account of substantial additions in the gross block instead of reducing balance. So earlier you were following reducing balance or WDB, now you move to straight line, which was earlier adopted. As a consequence, 21 crores. Depreciation is now less charge than it would be provided under the old method. 67 crores on reducing and 46 crores under SLM. Is this a policy change? No, this is an accounting estimate change whose effect will be given prospectively, but in the notes you will explain the impact of this estimate change. And last, provide for other than temporary fall in the value of investments which took place in the last 6 years amounting to 12 crores. Now, typically this is to be recorded as per AS 13 if you are measuring investments at cost. If you are recording investments as per Ind AS 109, typically these investments would be recorded either at amortized cost or FVOCI or FVTPL. So if they are recorded at either of these, then this loss should have already been recorded. But if it has not yet been recorded because you were showing these investments at cost, unless fair value was not determinable, cost recognition is not permitted, and hence that can be treated as an error if FVTPL or FVOCI was possible and you did not record it. However, if fair value was not determinable and hence you were showing it at cost, then yes, a 12 crore write-off is not a change in accounting policy or a change in accounting estimate. It is a write-off based on the facts. So this takes care of all the questions in the November 23 suggested answers. I hope this video was helpful to you. Please do write in the comments box if you need any other help or clarifications, and please do like, share and subscribe. It kind of means a lot to us, and that should be it. I'll share the PDF for the consolidation question on the Telegram channel. The link for that will be in the description. I'll see you soon with the next video. Till then, bye bye, take care and study hard.